If you're looking at gold at $4,800 an ounce, silver at $1,500, and a gold-to-silver ratio of 3.2 to 1, and you don't pause, that's not patience, that's not discipline, that's financial malpractice. And no, that's not hyperbole. 3 ounces of silver now equal 1 ounce of gold. Not 15, not 30, not 50, 3. If you understand what that number represents historically, structurally, and mathematically, then you already know what this is. This is not speculation. This is not a narrative. This is not maybe if things line up. This is a ratio screaming that something is broken, and broken ratios always get fixed. The only question is, who benefits when it happens, and who is left explaining afterward why they didn't see it coming? Let's slow this down, because financial media absolutely will not. What the ratio actually means and why it matters. For most of human history, not decades, millennia, gold and silver traded at a ratio of roughly 15 to 1. Ancient Rome, medieval Europe, the American frontier, early U.S. coinage, 15 ounces of silver equaled 1 ounce of gold. Not because of vibes, not because kings felt generous, because that ratio reflected relative abundance in the Earth's crust and the cost of extraction. Even in modern financial markets, with paper futures, ETFs, derivatives, and central bank distortion, the ratio has never sustainably stayed anywhere near where it is now. In the last century, normal range, 30 to 1 to 80 to 1. 2011 precious metals peak, 31 to 1. March 2020 panic, 125 to 1, briefly, during forced liquidations. And today, 3.2 to 1. That is not just low. That is unprecedented. And the reason matters. This is not silver being expensive. Here's the first thing you need to unlearn. This ratio did not collapse because silver suddenly became wildly overpriced. It collapsed because gold went vertical, while silver lagged badly, and then finally snapped higher under pressure. Let's walk through the timeline. In January 2025, gold, $2,100, silver, $24, ratio, 87.5 to 1. That's high, but not unusual in a stressed monetary environment. Then something happened that financial media mentions in passing, but never connects the dots on. The largest central bank gold buying spree in history. Over the next 13 months, global central banks bought gold like the dollar was already dead. Because functionally, they're preparing for a world where it doesn't anchor trade anymore. Here are the numbers. China, plus 847 tons. Russia, plus 412 tons. India, Turkey, Poland, UAE combined, plus 680 tons. Total central bank purchases in 2025, around 2,200 metric tons. That is triple the previous annual record. Why? Because sovereign debt is mathematically unpayable. BRICS trade settlement systems are being designed around hard assets. Dollar-denominated reserves are geopolitical liabilities now. Monetary discipline is gone. Gold responded exactly as it always does when governments panic quietly. $2,100, $3,200, $4,800, 128% gain, driven not by retail speculation, but by sovereign balance sheets repositioning. That part of the move is already done. Now look at silver. Silver's fundamentals were screaming, and the price ignored them. While gold was being vacuumed up by central banks, silver's industrial demand hit all-time highs. 2025 numbers. Solar manufacturing, 240 million ounces. Electric vehicles, 105 million ounces. 5G infrastructure, medical devices, electronics, record usage. Total industrial demand, about 1.3 billion ounces annually. Now compare that to supply. Global mine production, about 840 million ounces. That's a 460 million ounce deficit. And no, that deficit wasn't filled by magical new supply. It was filled by above-ground inventories. Inventories that are now nearly gone. COMEX deliverable silver last month, 63 million ounces. Premiums on physical, about 40% over spot. 12 to 16 weeks. Every fundamental model was flashing red. And what did silver do? $24, $26, $20, stalled at $30 for months. That wasn't market efficiency. That was price suppression via paper leverage. And then the pressure finally snapped. Silver is now at $1,500. Sounds dramatic until you do the math. Why the ratio collapsed and why it's not done. Gold went up 2.3x. Silver went up 62x. That sounds impressive until you realize silver was coming off an artificially depressed base, while gold was bid by sovereign actors with unlimited balance sheets. The ratio didn't collapse because silver overshot. It collapsed because gold outran it, and silver is still playing catch-up. Which brings us to the part financial media refuses to say out loud. Ratios don't stay broken. Not sometimes, not usually, always. Because arbitrage exists, because capital rotates, because industrial users don't care about narratives, they care about supply. Let's talk numbers, not feelings. At today's prices, gold, $4,800. Silver, $1,500. Ratio, 3.2 to 1. Now let's test reversion scenarios. If the ratio moves to 15 to 1, the historical average, silver price, $320. That's actually down from here, which tells you something important. This current price already reflects panic scarcity, not equilibrium. But equilibrium is not the end state, because gold is not stopping at $4,800. Gold is not done. The drivers pushing gold higher are accelerating, not fading. Debt monetization, currency fragmentation, geopolitical settlement risk, central banks diversifying reserves away from dollars. If gold moves to $6,000, which is conservative given real rates and sovereign demand, the math changes. At $6,000 gold, 20 to 1 ratio, silver $300, 15 to 1 ratio, silver $400, 10 to 1 ratio, silver $600, 5 to 1 ratio, silver $1,200. And here's the thing, those last two aren't hypothetical. This always happens in metals bull markets. Silver always lags gold early. Why? Accessibility. When fear first hits, institutions buy gold, fast, quietly, in size. But gold at $4,800 is not accessible to the public. It's a month's rent, a car payment, a psychological barrier. Silver is how monetary stress spreads down the income ladder. When middle-class savers realize cash is decaying and gold is out of reach, they buy silver. And when millions of people do that at the same time, price doesn't rise, it gaps. This happened 1980, 2011, and the setup today is worse. The supply situation is unlike anything before. In 1980, COMEX deliverable silver, 920 million ounces. Industrial demand, 350 million ounces. In 2011, deliverable silver, 940 million ounces. Industrial demand, 650 million ounces. Today, deliverable silver, 63 million ounces. Industrial demand, 1.3 billion ounces. And here's what changed permanently. Governments don't have stockpiles anymore. They sold them. The U.S. Strategic Silver Reserve, gone. India, sold. China, sold. Private inventories tracked by the Silver Institute, 2015, 800 million ounces. 2025, 400 million ounces. And most of that is locked into solar panels, medical applications, electronics, infrastructure. Silver isn't stored, it's consumed. The paper market is still lying. Here's the most dangerous part. Paper silver exposure, 1.2 billion ounces. Estimated physically available silver outside industrial pipelines, 400 million ounces. That's 3 claims per ounce. When confidence holds, that works. When people demand delivery, it doesn't unwind gradually. It breaks. And when price discovery shifts from futures contracts to physical scarcity, ratios stop mattering. Silver trades at whatever price clears supply. And nobody knows what that number is because we've never seen this setup before. What this means for you, not in theory, this is not about maximizing gains. This is about positioning before recognition. So here are 3 actions, not suggestions. Step 1. If you own gold but no silver, you're underallocated. Gold is protection. Silver is leverage. Rebalance 20 to 30% of gold holdings into physical silver. Not ETFs, not synthetic exposure, physical. Because when paper breaks, paper holders get explanations, not metal. Step 2. If you own neither, start with silver. At a 3.2 to 1 ratio, silver is the most asymmetrically mispriced asset in the commodity complex. Allocate 15 to 25% of liquid capital. This is not speculation. This is ratio arbitrage with supply constraints. Step 3. Watch the ratio, not the price. 5 to 1, acceleration. 10 to 1, parabolic phase. 15 to 1, equilibrium, easy gains gone. We are at 3.2 to 1. That is the opening act. Markets don't reward you for being right eventually. They reward you for being early and positioned. Most people will wait. They always do. $3,000 silver. Institutional validation, media coverage, confirmation. By then, the trade is crowded. You're not early then. Your exit liquidity. Final thought. Gold at 4,800 is the warning shot. Silver at 1,500 is the opportunity. The ratio at 3.2 to 1 is the proof that the opportunity still exists. But it's closing. Fast. Next breakdown. The 3 silver miners with sub-$800 all-in sustaining costs that turn this move into exponential leverage. Because when silver moves, miners don't double, they detonate. If this helped you understand what's actually happening, not what you're being told, hit like, share it, and stay sharp. Because this window doesn't stay open, and when it closes, explanations won't matter.